A very warm welcome once again, and I thought I would quickly cover the key pillars which, most of the times when partners work with us and they start interacting with us, they are kind of, there are some concepts which are very new to them. Some partners they get to know, they understand the terminology that we use, and certain partners they are not able to use the terminology. They don't understand the terminology which we use uh, in our structuring discussions. So, just in order to ensure that we are all on the same page, we've just put a few slides, maybe a couple of slides, just to talk a bit about how um you know our framework of how we actually fund and how we go about it. So for with so the first point which we need to understand is that when we, as the Gazelle partners, invest debt capital into a company, uh, typically, like you must have seen that when you go to an investor, but that investor could be a private equity firm or venture capital entity or family office. Typically, there is a due diligence phase which goes on, in which there is a legal, financial, all the paperwork, everything is thoroughly checked. Now, the thoroughness with which the entire paperwork is checked for a firm, it could take a lot of time and effort, and it takes a lot of I would say it is it is time consuming, and then that could be a roadblock to start business. So what we do or what we encourage is that a new firm in UAE started, right? And that new firm acts as, because it'll be a new firm, that firm is used as a stepping stone for buying other firms which are already existing. So, for instance, suppose you have a firm in, say, Paris, and you're looking for investment into that company, and you come to us, and then you have agreed, and you're interested in the fixed dilution debt infusion model. You've just come across that, and you liked it, and then you want to work with us. So, having said that, what it means is that we are going to invest debt capital at a very, maybe 3 to 4% or something around, in under 5, I would say, percent per annum. We will use that debt, and we will put that debt into the your firm in Paris, and take a fixed dilution in your Paris based firm. So how do we do that, right? So the procedure which we have developed is that we first start a firm. We, as in you will have to pay. You'll have to pay for that. You'll have to start that firm in Dubai, because Dubai, being a very legal and tax friendly country, it's very easy to get a license and start business. So that UAE firm would then act as the parent firm, which will eventually, after all the credit line, credit work, everything is ready in the Dubai firm, uh, that firm will be used to purchase the Paris firm eventually, and any other firms that you intend to purchase. So let us say, let us take a scenario wherein, say, the Paris firm is the first entity, and then there are three more entities that you want to purchase, and each entity is in, say, entity is in UK, one entity is in the US, one entity is in India. So there are totally four entities, right? So the first is a Paris entity, and then the three other entities. So there are four entities which need to be clubbed, right? Or even if you don't have the other three entities and you just have the Paris entity, fundamentally, the UAE entity, which I just mentioned to you about, it's a new entity that will be the umbrella company which shall purchase the Paris entity, and the other three entities. This is called the buy and build model. And buy and build model, you can Google it, you can understand more about it. Fundamentally, this is the fastest way to grow in the market. Um, and it will help you achieve rapid growth and market dominance. That's the best way there is in terms of and then eventually you buy several target companies, and I can go on and on and on how to identify those target companies, what is acquisition strategy you can follow. Fundamentally, you find those companies which are complementary, or supplementary to your current line of business, and these companies, they are basically, they align to the business goals and strategies. So you identify such companies, you do the due diligence of those companies, and then you purchase those companies. So all this work, it is all due diligence based. So there has to be due diligence for all the target companies that need to be purchased, and also due diligence of the Paris company. All of this is done, and then there's a valuation done, and all of that. And then the Dubai company, which is newly formed company, purchases all these companies. This is the fastest way to grow any business, and for which we are injecting debt, right? And that debt is through, uh, we are injecting collateral, and the collateral is India based collateral. We have our own land bank partners in India, and we use that collateral to raise debt. And that debt is, that debt is actually raised in the UAE company, but we are using the collateral of India. So there is a tie. We are doing some SPV work in India. There is some SPV work which we do in Dubai, which brings me to the point of SPV, which is a special purpose vehicle, which we are basically using to do a few certain financial transactions to offset the risk. So as you know that this is all collateral based debt, which we spoke about, right? So we are getting in collateral from India, and on that India based collateral we are bringing in equity. Sorry, we're bringing in debt. So that collateral injection is possible, and that revenue, I mean, what do you say? The kind of credit line which we are enabling in the SPV in Dubai, uh, all of that is only possible if we establish or we use an existing SPV in Dubai and in India, and all of that paperwork, the collateral injection, SPV creation, and all that is actually the needed work that needs to be done in the background, so that we can get in the collateral based debt for the firm. And so I just wanted to talk about these points, that and these SPVs are, SPV is actually the legal structure and the regulations governing an SPV. It varies as per the jurisdiction. So SPV is better that we start in UAE or in India, and in India, and it also helps. This SPV is helping us, do some tax planning, also, uh, also like in terms of structuring in mergers and acquisitions and project financing and all of this. This is actually very very useful and required for getting in, bringing in collateral based debt. And it's also useful for, risk isolation, because as you know that there is a lot of collateral work that we do, and all of that we do that work through establishing an SPV. And I can go on and on and on how we, what we need to do and all of that, but just wanted to talk about this briefly. And one more thing is that the debt is UAE and India based. So we can get a debt from India or from UAE. The rates of interest are different, We use the banking channel, sometimes we use the investment banking channel, or the private fund pool that we have, or the family office network we have. So all of this, it comes at a rate of interest, and the rate of interest is it's different in different countries. The taxation is different in, as you know, the taxation in Dubai is very different from the taxation in India. And see, your company can be anywhere. It can be the United States, it can be in Australia, it can be in Europe. That is really secondary. But fundamentally, the collateral that we bring to the table is from India, and the SPV is UAE based because of the tax, friendliness of UAE. And the SPV, we also do some SPV work in India. So all of this work is required, the pre work is required so that the company is ready to get that needed credit line from either the bank or the investment bank, or the private family office funds that we have. And then the another point I wanted to talk about is the equity capital. So equity capital is very subjective. Like, there are a lot of partners who ask us, like, we do not want to take any debt. We just want pure equity. We don't want that headache of debt. But equity capital, it's not guaranteed. So it all depends upon the interest of our investor pool. If they feel that yes, um, they want to invest in the business, they will, then there's an investment, we make through the equity capital. Sometimes the investor might ask you for collateral, sometimes they may not ask you for collateral, so it's very subjective. So the debt model and equity model are very different. The debt model, as I said, it is collateral based. It is The collateral is in India, the SPV is in UAE. Your firm can be anywhere, and the SPV, I mean, the SPV is both in UAE and in India, and all of this pre-work is done, and then we get the collateral-based debt, and we there is a fixed dilution that we take in the firm. That is for the debt capital. And for some firms, we might just not want to invest in those firms, and these are the firms in which the entrepreneur typically has had no experience. It is just at an idea stage, and we cannot take the risk, or the business is at a stage and an industry that we do not want to take a risk. We just give the loan to the entrepreneur, we just take a success fee, and that's about it. That's about debt, right? And then we have equity. As I said, equity is subject to a case to case basis. So I think I've covered both. I've covered debt based investment, and also simple debt, wherein we just give the promoter just a debt. And I've also covered the equity piece, right? Um, and to quickly go through, like, if you have any questions, please feel free to WhatsApp me on my number anytime. Um, and So fundamentally, any business owner who walks in to us, sometimes, they come with a plan, but then after they talk to us and everything, they go back and they rework and they come back with a new plan. So fundamentally, I would always try to urge you to understand what is, and I would want to also understand what is the vision of your firm. What do you want to do with it in the next 5 years? Do you want to give it to another company, like you want to sell it off? So if yes, then have you found your future buyer? If you want to say, just grow it and give it on to your kids, then, like, what do you want to do? Like, do you want to take profits monthly from the business, or you want to take it yearly or quarterly, and then you want to give it over to the business to your kids, say 5 years or 10 years down the lane, whatever the plan is. Third point is, the exit strategy is very important. See, in the sense, I mean, when I say exit strategy, you can go on and on. And, like, as I said, some entrepreneurs want to sell it off after 5 years. So that is their um, their plan, right? Some just they just want to sell it off to another firm or a private equity firm or bigger company. So if that is your exit strategy, then your planning should be different. You should know who is your future buyer, and like whether it is another company or you want to go for an IPO, because what would you do after 5 years? If you just want to keep the company for IPO, then you're just giving, you know, you'll keep one stake and most of it just goes off um, into IPO mode. Or you want to, like, say you want to do a spin-off or a carve out. In this case, you want to like keep a part of your company and sell off a part of your company. In that case, it's very important to keep the financial banking and the accounting and all separate. So I want to know, like, we want to know what you want to do with the company after 5 years. um Also, you want to do you want to just make your employees, like, purchase stocks in your company slowly slowly, you want to dilute more of it to the management team of the company, right? Or you want to just give it off to another merger or acquisition company, or you just want to sell off the whole company. That's the long-term strategy. Or you want to hold part of it, and then you want to sell it off. So first, you please research on what you want to do with the company. I'm more keen to know what you want to do with it, what type of profits. So because we are flexible, as a firm, we are flexible. Normally, as long as a company we are invested in, because when we are talking about debt or equity, it's about break even. Till break even, we will anyway be there in the company. We may leave the company if we feel we want to exit the company, maybe after few years, or we may not leave the company. I do not know. That is very subjective. Some companies we do not leave because we the founder wants to grow it further. They want us to stick around, and then we also feel that there's good synergies between the founder and us, so we continue to stay in the company. And throughout that tenure, we take a fixed salary. So there is a salary every month, or salary which we take as directors. Then if we want to um, exit, then we will do a company valuation, and then you will have to buy us out, and then we will exit the company. We So that's also one way. Like, we'll exit maybe, yeah, whenever we want to exit and we feel like exiting. There is no force that you want us to exit on so and so time and timeline. If yes, then we will also put our terms forth, and then we will discuss and we will come to an exit point, like after how many years or whatever. But fundamentally, we normally we want to stick around and grow the company as much, and then till it is sold off, or somebody buys us out, or something like that. So we'll have to figure it out. So that's about the exit strategy. So, and the rate of interest, as you know, I already touched upon that. In UAE, there's a different rate of interest we give. So that's the reason we are doing everything through UAE. There is no corporate tax in the free zones. So we already have established tie ups with the required free zones in Dubai, and also in India. Uh, so my team, we are very well conversant with all the renewals. Like, what you need to understand is, in Dubai, we take to start off with, we take a 1 year license. It's around, um, it depends. It's 25,000 dirham to register a new firm, at least as on date. And then after the firm is registered, that 25,000 is allowed as it's a one-time registration fee. And every year there is a renewal for around, I would say, around 13,000 dirham is a renewal license fee, for which we pay to the government to renew the license. So always remember that when you start the firm in Dubai, it has to be renewed every year. Otherwise, there are penalties You have to close the we have to close the business. So when you enter the whole model of working with us, you need to understand that every license, every business license, whether it's in India or whether it is in UAE or wherever it is, it all has to be maintained. So you cannot like think of just making some part payments, or if you go into a loss right after we give you the funding, uh, then it's kind of a very risky situation for us, and we do not take any liability for it. See, for instance, what I mean to say is, we are strategic investors. We are here to enable you to run the show. We do not run the operations of any business. This is very important for you to know. We do not run the operations. We only supervise, we help with strategy, we only um, help you navigate through the risks, but we will not run any operations. This is very, very important. Yes, we can help with strategic advisory, we can do all of that. Now, it depends upon you. How do you want us to associate ourselves with you? What type of support are you looking for? Are you looking for strategic support, strategic advisory support also, or you want you want us to not disturb you and just let you be? But of course we will ask you, because there's a huge investments are going into the business. Obviously we will want to know about how that money is being utilized, and we will do an audit. We will have a control mechanism of how these funds and invoicing, everything will be tracked. I agree with that, but fundamentally we would not run the operations. So when that is the case, when since we do not run the operations, or automatically that brings us to the point that we don't have any control on how the operations are being led. So it becomes, and there is a lot of collateral tied to it. Or even in the equity business, right, we do not run the operations, everything you are running the show. So it becomes very important for us to uh, let you know that any risk that you bring to the table, um, the cash flow is required to sustain the costs. So when you register, so UAE company registration, as I said, it's a 1 year license, and every year we renew it. In India, the collateral is injected into the SPV. So there is an SPV in India, there's an SPV in Dubai, and there is a company. There is SPV work both in India and Dubai. So that has to be maintained every year, right? There's a maintenance charge to that, because the collateral, it comes with a cost, and there is a small charge. So we can discuss about the expenses and all of that. Then there's in India, there is a company audit, income tax returns filing, ROC filing, KYC of the directors. Every year we have to maintain those companies, so all of that cost, etc., is treated as a business expense post funding, number one. Number two, before the credit line or funding comes into the business, for debt funding, all the costs will be borne by yourself and your team, in the sense the founder and the team. We do not you know pay for any of the company registrations, the paperwork, the due diligence, the preliminary due diligence, the collateral work. All of that, obviously, you all will have to pay. We will not pay. We cannot take that risk, because we have done that in the past, and then after that, what has happened is, after we have paid, they kind of just wanted to take the investment from elsewhere, and it was a big uh, jolt for us, because we had already put in a lot of paperwork, legal work, and all of that, and then they just kind of they found better pastures. For some reason, they wanted to. There was a fight between the partners. In one situation, another situation, they just took investment from somewhere else, which was faster for them, and so we were stuck. So we don't want to take the risk anymore. Now, with equity capital, however, if there is a show of interest from the investor pool, we might as well pay for the entire due diligence of the firm, which means that all the travel, all the due diligence is on us for equity capital. But I do not guarantee that. We do not guarantee. Sometimes it is the case that yes, we feel there is a we want to take that risk and we can take that risk, then we will put in for the due diligence. Otherwise, it's a due diligence and all of that is uh, at least before the starting business, right? Before we start the business with you, you have to be ready to pay for the company registrations, the licenses, till the credit line is up and running. After the credit line is up and running, of course that credit line can be used for all other business expenses. And of course there is a success fee. There's a fee to there's a fee to everything, right? So there's after the funding is after the debt funding is credit line is released, there will definitely be a success percentage. We can discuss about that as well. So there is a fees attached to all of this. So just rough approximate numbers, I can just give you some very approximate numbers. It's 25,000 dirham for new company registration in in Dubai, right? So the first year there is at least, so there is SPV as well required in Dubai, which is another entity. So we can probably use an existing entity if there's one, or we can figure that out. Then there's a renewal fee. Every year there's a renewal fee of 12 to 13,000 dirham for companies in Dubai. In India, it depends. It depends. Like company registration is pretty cheap. It's not as expensive as it's Dubai. Then there's collateral work and credit enhancement work, and there is a certain capital. It comes to. I mean, I can give you the figure once you show some, like, okay, you want to move forward with this road. We use that capital, a small amount of capital, of the huge pile of capital which we're planning for. It's a small pile which we use, that we need to put some share capital into the Dubai company and use that same capital for all the paperwork, the collateral work. It's a process by in itself. So all of this is going to take time, and the timelines have already mentioned in the other video. So this is all a process, right? And you have to make the company funding ready. It's not like you just walk in and take money and go. It doesn't work that way, because there are a lot of people who came to us, they don't know how it works, how funding works and how investment works, and they don't understand these things. And it just took us a lot more time to explain all these things. So we are just making it, I'm just making it very clear upfront on the first time itself. And then of course we will definitely get onto a call and understand more about your questions, doubts, everything. And we're happy to hear more from you. um, so the kind of startups and SMEs are like, we are open to any SME, any startup at any stage. We will tailor a solution accordingly. Like for instance, as I said, at an idea stage, we just get a loan for you, and that's it. And that too, we will see like how much loan, what loan, everything. We will not just let loose so easily. If it is investment model, of course, we invest through debt for a fixed dilution, uh, and I cannot, for the interest of, this is actually some public information. We can always discuss what dilution and all of that post when we get in touch. And also we do loans for certain projects, just loan and no investment, as loan for investment. Also we do equity infusion, wherein, and just pure equity, there is no capital, there's no debt which we are infusing. When it comes to the collateral piece, collateral is something which is third party collateral, which from India, and there is SPV work in India and in Dubai. It all comes with a fee. Um, and I've given you some rough approximate numbers. There is travel involved, because my team will have to travel to Dubai for the current account opening. There is a minimum capital which we need to put as a minimum balance. We have to give some signatures as a physical, biometric and all of that, which happens in Dubai. And even in India, there is travel involved, which is for the collateral. So my team has to travel, and there's a lot of paperwork, because getting real estate and collateral into a business is not easy. There's a lot of due diligence work, there is physical visit, there is valuation work. So all of this work is required. Only then, of course, it comes to the next step. So we have been able to, I would say, do all this in a very fast way, because we are into this since many years, right? And we are good at this. We know how to. That's what sets us apart. We know how to get. Um, we understand like how to get debt in the fastest turnaround time. We have written certain articles on LinkedIn and all, you can check out. Um, and there are some, you can just check out. So basically, we do like what we do is there are a lot of assets like residences, buildings, commercial establishments, bungalows, multifamily homes, factories. So we use these as real estate, right? And then on that particular real estate, there is a loan. And why would somebody give the real estate? For instance, if you have, say, $1 million house, would you give it just like that? No, you will see what you are getting in return. So there is a sharing basis. We for the loan which is dispersed, the collateral owner takes certain share of that. Mostly it is on a 50-50 basis. And the rest of the 50 goes to your company, and you and the company. So it's basically a business loan. So there's a different rate of interest which we get in India and a different rate of interest in Dubai. Mm, and we can do loans for any amount. Like it's not a limit. Like if you want 5 million, 10 million, 15 million, we want to know the plan. That is more important. Like suppose you say we want $30 million, I would ask you why. And then you will say, okay, I need to purchase these companies, and this is the EBITDA, this is the valuation, this is the multiplier. So it makes sense. Or say you want to get to construction. So it all depends on project to project basis. So you have to tell how much, because there's really we can enable in the first transaction itself we can do an entire 20 to 30 million dollar fundraise. We can do that, but you need to explain. Plus we'll also see what assets your business has. uh, it need not have assets, but we will do an evaluation, right? We will see like uh, what is the situation in your business, and is it uh, really worth it. And so there are a lot of there's a lot of things which we can explore, because we try to do something through UAE always, because UAE is very 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 friendly for us in terms of better rates, and we get huge limits. And some one more thing is basically SBLCs, BGs. Like there are certain deals in which they're very, there has to be, like if you've seen exports and imports, we need to see that the purchase orders that you bring to the table, that purchase order is backed by a bank guarantee or an SBLC or a letter of credit. So we do funding against all these as well. And we do NPA restructuring. So we do end to end. So we are happy to know more about your business and what you want to do and everything. So thanks for your time, and it's been quite a long call. We would like to hear from you. There's a form, and hope you fill that form, and we'll circle back in and we will take it from there. Thank you so much.